If you've been waiting for Canadian real estate to crash, I have news. It's not happening. But if you've been priced out for years, 2026 actually brings some relief. The national average home price is down 4.9% year over year. Inventory is up and mortgage rates have been stabilized around 4.5. The market is the most balanced it's been since 2019. But that doesn't automatically mean you should buy, sell, or wait. Let me show you what's really happening across Canada and what you should do. Welcome back to KP Money Talks, and today we're cutting through the noise of Canada's 2026 housing market. I'm going to give you real data on prices, mortgage rates, inventory, and regional differences. Then tell you exactly when it makes sense to buy, sell, or stay on the sidelines as a Canadian. Hit the subscribe button for Canadian real estate and personal finance content, and let's dive into it. Let's start with where we actually are in early 2026. Prices are softening. The national average home price is $652,941 as of January 2026, down 2.6% year over year. The benchmark home price index shows an even steeper decline at 4.9 annually. This marks the 8th consecutive month of price declines, but we're not seeing a crash. We're seeing a normalization over years of unstable growth. Sales are down and inventory is up. Home sales in January 2026 were down 12.5% compared to last year, while new listings jumped 7.3% month over month. Which means buyers have more choices and more negotiating power than they've had in years. The sales to new listing ratio is at 45%, which is a balanced market. Mortgage rates have stabilized. The Bank of Canada's overnight rate sits at 2.25% after 4 consecutive cuts to 2025. Fixed mortgage rates are hovering around 4.5% to 5%, down from the 6% plus highs of 2023 and 2024. But here's the reality. The Bank of Canada has signaled it's done cutting for now. Don't expect rates to drop to pandemic-era 2% levels. Those days are over. Economic uncertainty weighs heavy. US tariffs, slower immigration, and weak job growth has dampened demand. Canada's GDP is forecast to grow just 0.7% in 2026, one of the weakest years outside of recession. CMHC even warned that Canada could slip into a mild recession if businesses have their sentiments worsen further. When you consider it, there is no single Canadian housing market. Your experience entirely depends on where you are. Toronto and the GTA. Buyer's market. Toronto has significant price declines, especially for condos. The condo market is oversupplied as investors list properties amid high carrying costs and falling rents. Average home price in the GTA are down, inventory is elevated, and buyers have leverage. The very tight supply and demand condition of recent years have flipped to favor buyers. On the other hand, Vancouver and BC have a softening but not collapsing market. Vancouver prices are down modestly, with continued affordability challenges keeping many buyers on the sideline. The demand remains weak, but purpose-built rental construction is surging. Rental vacancy rates are rising as record number of new rental apartments are complete. A good news for renters, but not great for landlords or condo investors. Let's talk about Calgary, which is a still hot market. Calgary remains one of Canada's strongest markets, driven by interprovincial migration from BC and Ontario, plus a local economy outperforming national growth. Prices are forecast to increase 1.5% in 2026, with detached homes up 3%. Sales activity is above the 10-year average despite some cooling. When talking about the prairies, the market is very resilient. That's talking about Saskatoon, Winnipeg, and Regina. Saskatoon led Canada in economic growth in 2024 and 2025, and is forecast to continue strong performance with 2.4% real GDP growth in 2026. Housing remains highly affordable, demand is steady, and prices are forecast to rise modestly from 2 to 3%. These markets avoided the pandemic era frenzy and are now benefiting. And the remaining Atlantic Canada is on a cooling after hot run market. Halifax, Moncton, and other Atlantic markets saw huge price gains during the pandemic era but are now cooling as population growth slows and economic uncertainty rises. Price growth is expected to moderate significantly in 2026. Now the big bag question. Should you buy in 2026? Well, in my humble opinion, you should buy if you are in Ontario or BC and have been priced out. If you've been waiting for affordability to improve in Toronto or Vancouver, 2026 is the most balanced market you've seen in years. Prices are down, inventory is up, and you actually have negotiating power. CMHC's new mortgage rules also help first timers. You plan to stay 7+ years. With economic uncertainty and slow growth forecast through 2027, real estate is not a short-term play. Only buy if you're committed to staying long enough to ride out market cycles. You can handle payment shocks. Mortgage stress tests require you to qualify at rates 2% higher than your actual rate. Make sure you can handle payments even if rates rise when you renew in 5 years. Many Canadians renewing in 2026 face payment increases as pandemic-era ultra-low rates expires. You are not overstretching. With economic uncertainty and potential job losses, don't stretch to absolute maximum you qualify for. Leave room for changes. You should wait if you're in a hot market like Calgary where prices are still rising and supply is tight. You have job insecurity or work in a tariff-exposed industry. You might need to relocate within 3 to 5 years. You're hoping for a further 10 to 20% price drop, which is unlikely according to forecasts. So here's my take on Canada's 2026 real estate market. For buyers, 2026 is the best buyer's market year since 2019. If you're in Ontario or BC, have stable income, and plan to stay long-term, this is your window. Pent-up demand from first-time buyers is expected to drive sales recovery, but prices are forecast to stay largely flat all throughout the country with only modest gains, 1 to 2.3%. Don't expect a crash, but don't rush into panic buying either. For sellers, 2026 is a reset year. Not a seller's market like 2021, but not a fire sale either. You need to price competitively and be patient. Condo sellers in Toronto, Vancouver face the toughest conditions. Detached home sellers in the prairies are in the best positions. As for everyone, the big risks are economic recession, tariff impacts on jobs, mortgage renewal payment shocks for those with expiring pandemic-era rates. CMHC forecasts that housing demand will remain below historical averages through 2027, with modest sales growth but no boom. Canada is not building enough new homes to meet long-term demand, so severe price crashes are unlikely, but affordability will remain challenging. The bottom line is that Canada's 2026 housing market is in a normalization mode. Prices are softening, inventory is rising, and buyers have more power. If you're buying in Ontario and BC with stable income and long-term plans, this is your chance. If you're selling, be realistic about pricing market and other conditions. If you're waiting for a 30% crash, you'll probably wait forever. Now hit that like button and subscribe if this cleared up your 2026 real estate expectations and other strategies. Leave a comment below and thank you for watching. I'll see you in the next one,